a series of committee discussions supported by rigorous staff analysis. As is appropriate in our democratic society, we have sought extensive engagement with the public throughout the review. The Fed Listens events built on a long-standing practice around the Federal Reserve System of engaging with community groups. The 15 events involved a wide range of participants: workforce development groups, union members, small business owners, residents of low and moderate income communities, retirees, and others, to hear about how our policies affect people's daily lives and livelihoods. The stories we heard at Fed Listens became a potent vehicle for us to connect with the people and communities that our policies are intended to benefit. One of the clear messages we heard was that the strong labor market that prevailed before the pandemic was generating employment opportunities for many Americans who in the past had not found jobs readily available. A clear takeaway from these events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. The research conference brought together some of the world's leading academic experts to address topics central to our review, and the presentations and robust discussion we engaged in were an important input to our review process. Finally, the committee explored the range of issues that were brought to light during the course of review in 5 consecutive meetings beginning in July 2019. Analytical staff work put together by teams across the Federal Reserve System provided essential background for each of the committee's discussions. Our plans to conclude the review earlier this year were, like so many things, delayed by the arrival of the pandemic. When we resumed our discussions last month, we turned our attention to distilling the most important lessons of the review in a revised statement on longer-run goals and monetary policy strategy. The federated structure of the Federal Reserve, reflected in the FOMC, ensures that we always have a diverse range of perspectives on monetary policy, and that is certainly the case today. Nonetheless, I am pleased to say that the revised consensus statement was adopted today with the unanimous support of committee participants. Our new consensus statement, like its predecessor, explains how we interpret the mandate Congress has given us and describes the broad framework that we believe will best promote our maximum employment and price stability goals. Before addressing the key changes in our statement, let me highlight some areas of continuity. We continue to believe that specifying a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. The significant shifts in estimates of the natural rate of unemployment over the past decade reinforce this point. In addition, we have not changed our view that a longer-run inflation rate of 2% is most consistent with our mandate to promote both maximum employment and price stability. Finally, we continue to believe that monetary policy must be forward-looking, taking into account the expectations of households and businesses and the lags in monetary policy's effect on the economy. Thus, our policy actions continue to depend on the economic outlook as well as the risks to the outlook, including potential risks to the financial system that could of our goals. The key innovations in our new consensus statement reflect the changes in the economy I described. Our new statement explicitly acknowledges the challenge posed by the proximity of interest rates to the effective lower bound. By reducing our scope to support the economy by cutting interest rates, the lower bound increases downward risks to employment and inflation. To counter these risks, we are prepared to use our full range of tools to support the economy. With regard to the employment side of our mandate, our revised statement emphasizes that maximum employment is a broad-based and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for many in low and moderate income communities. In addition, our revised statement says that our policy decision will be informed by our assessments of the shortfalls of employment from its maximum level, rather than by deviations from its maximum level, as in our previous statement. This change may appear subtle, but it reflects our view that a robust job market can be sustained without causing an outbreak of inflation. In earlier decades, when the Phillips curve was steeper, inflation tended to rise noticeably in response to a strengthening labor market. It was sometimes appropriate for that to tighten monetary policy as employment rose toward its estimated maximum level in order to stave off an unwelcome rise in inflation. The change to shortfalls clarifies that going forward, employment can run at or above time estimates of its maximum level without causing concern, unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. Of course, when employment is below its maximum level, as is so clearly the case now, we will actively seek to minimize that shortfall by using our tools to support economic growth and job creation. We have also made important changes with regard to the price stability side of our mandate. Our longer run goal continues to be an inflation rate of 2%. Our statement emphasizes that our actions to achieve both sides of our dual mandate will be most effective if longer-term inflation expectations remain well anchored at 2%. However, if inflation runs below 2% following economic downturns, but never moves above 2% even when the economy is strong, then, over time, inflation will average less than 2%. Households and businesses will come to expect this result, meaning that inflation expectations would tend to move below our inflation goal and pull realized inflation down. To prevent this outcome and the adverse dynamics that could ensue, our new statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. Our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. Of course, if excessive inflationary pressures were to build, or inflation expectations were to ratchet above levels consistent with our goal, we would not hesitate to act. The revisions to our statement add up to a robust updating of our monetary policy framework. To an extent, these revisions reflect the way we have been conducting policy in recent years. At the same time, however, there are some important new features. Overall, our new statement on longer-run goals and monetary policy strategy conveys our continued strong commitment to achieving our goals, given the difficult challenges presented by the proximity of interest rates to the effective lower bound. In conducting monetary policy, we will remain highly focused on fostering as strong a labor market as possible for the benefit of all Americans. And we will steadfastly seek to achieve a 2% inflation rate over time. Our review has provided a platform for productive discussion and engagement with the public we serve. The Fed Listens events helped us connect with our core constituency, the American people, and hear directly how their everyday lives are affected by policies. We believe that conducting a review at regular intervals is a good institutional practice, providing valuable feedback and enhancing transparency and accountability. And with the ever-changing economy, future reviews will allow us to take a step back, reflect on what we've learned, and adapt our practices as we strive to achieve our dual mandate goals. As our statement indicates, we plan to undertake a thorough public review of our monetary policy strategy, tools, and communication practices roughly every 5 years. Thank you very much.
And thank you, Chair Powell, for your remarks and also for engaging in a follow-up conversation. I actually believe that
Sorry, I can hear you. I think I can hear you now, Susan.
Okay, thank you very much, Chair Powell, both for your remarks about the new consensus statement and also for engaging in a follow-up conversation. I believe that this is actually the first time that after the chair's remarks at the Jackson Hole conference, there has been a follow-up question and answer session. And so another first. That I think that's actually very much in keeping with the public nature of the framework review that you just described for us. And so I wanted to commend for that as well. Why don't we just dig right in, and I'd like to talk more about some of the topics that you covered. And I think why don't we start with where you ended up, which is focused on the changes in the inflation strategy that you'll be following going forward. So as you explained to us, the inflation long-term target remained at 2%. However, going forward, you could shift to a flexible average inflation targeting strategy. And while there's a lot of discussion in the academic literature and policy wonks are well aware of what an average inflation targeting strategy is like, I wonder if you'd say more about how you would communicate that to the public. To what extent is this going to seem like a real change?
Well, so the public communication of it is very important, as you point out. And as I mentioned in my remarks, we're well in the Fed Listens events and many other engagements that people don't generally think about inflation moving up as a good thing. The thing there is that we're talking about inflation moving moderately, which is to say the overshoots will be moderate, which is to say not large, and they will for some time, which is to say not permanent or sustained for very long periods of time. So I think it's very important that we get that message out. It's also important that I think that people understand that this is not a formulaic approach. The committee will continue to consider all of the things that it typically considers in making monetary policy, but will aspire to have inflation run above 2% after periods in which it runs for an extended period below 2%, so that we can average 2%. So I think that concept should be well understood, and I think it's the appropriate one. When we began the review, we understood that the situation we're in calls for an exploration of makeup strategies of various kinds, and this seems to us to be the right makeup strategy, where undershoots of inflation are not forgotten, but are made up in a way that allows us to to continue to consider all the other things that come into monetary policy, often unexpectedly, rather than trying to follow a particular formula.
Thank you. So one way to think about that perhaps is the way that your colleague, Governor Clarida, has described it. It's more of an evolution, perhaps, than a revolution. So if I could just,
I think that's very fair. Go ahead.
If I could just push that a little bit further, and we'll come back to the comments that you made about the framework, but with so much focus on the really challenging economic situation, the crisis that we're in at the moment, are there changes in monetary policy that people should expect to see as a result of some of these changes in the strategy that you have walked us through?
So I guess I would just set the stage a little bit. We began the review we announced it publicly that we were beginning a review in early 2019. So and we had planned to announce our conclusions, and indeed we're ready to announce our conclusions in the April or June meeting this year. So most of the work that was done, and there was a lot of work done, took place during 2019. So the review is meant to establish a framework for monetary policy that will guide our decisions for the foreseeable future. It was meant to take into account the learning that we did in watching a full business cycle take place after the global financial crisis. We had seen a full business cycle or close to it, And now we have indeed seen a business cycle. So I think we thought it was time to update. So it wasn't designed to dictate any particular future decision about interest rates or other monetary policies. However, all of the things we do going forward will reflect the changes that we've made to the framework. So I would think of it that way. It doesn't dictate particular outcomes, though, at particular meetings or the timing of those outcomes, other than the goals that we're seeking to achieve.
So you mentioned a bit, and I'd like to hear a bit more about this. The rationale and your thinking for launching this review to begin with. You've mentioned that it was launched, of course, 18 months ago, so well before the current context. And I wonder if you'd say more about both what your motivation was for launching this, but also whether, as you look back on what the process was and how it unfolded, if you would have done anything differently.
Sure. So the review is really part of a broader program of enhanced transparency and accountability, really something the Fed's been working on for 30 plus years now. Today surveys show that public faith in large institutions around the world is under pressure. And so I think institutions like the Fed have to aggressively seek transparency and accountability to preserve our democratic legitimacy. And there are a bunch of things that we're doing. The review was the center of that, though. I thought other central banks have done various forms of reviews, not all of them of their broad monetary policy, but some had, and I thought this would be something we could do to get great benefits and also be able to update our framework. And the economic question we had to answer was how to adapt our framework to what we really had learned since the global financial crisis during that long expansion. As I mentioned, we knew that we were going to be closer to the effective lower bound in all likelihood, and had to address that as I described in my remarks. We didn't know how it would come out. I'm very happy with where it came out. I will, if you'll forgive me or allow me, just say for a second that we were in the design process of this when Vice Chair Rich Clarida arrived in the fall of 2018, and there were only 3 governors, I think, at the time. he had the time and really took this on and led it. And we would not be sitting here today talking about this without his great leadership efforts in bringing this thing forward. I'd also mention the other members of the subcommittee on communications, which Rich Clare's, Governor Brainerd, Eric Rosengren, and pretty much every member of the FOMC, every participant can look at the document and see their own views and input reflected. So I think in terms of, I mentioned some of the things. I think there were great gains just in the process of engaging with lawmakers and engaging with the general public on these issues and seeking input and accountability. I think that is a most welcome thing when you do that. And so I think even apart from the gains in the framework, that was something I was quite struck by. The Fed Listens events were just really striking. If you were in Chicago, I think that conference, there were 2 panels of people from low and moderate income communities who spoke about the economy in their lives, and it was just riveting. It was really, that was the highlight of that conference, which of course was chocked with global monetary policy experts. But to hear them talking about what a tight labor market means in their communities was something that none of us will forget. And I think we knew that intellectually, but I think hearing it a lot over the course of Fed Listens, and then seeing the sharing of the benefits of a labor market that's tight, in the sort of 8th and 9th years of the expansion, wages began to move up more for people at the lower end. We saw labor force participation. We saw employers doing lots and lots of things to recruit people who might not have been recruited earlier. So it's a very virtuous thing, and one that I mentioned in my remarks will take support from Congress over time too. It's not just about monetary policy. It's about education. It's about training. It's about healthcare. It's about all the things that enable people to get into the labor force and stay there and progress in their careers through the labor force. So I think those are some of the things I take away from the process.
So, I mean, as someone who did participate in at least some pieces of the process, I will also comment on just how public and OPED, as you mentioned, is often not thought of as an institution that really does reach out to the public and engage in different ways. I wonder, I wonder if you'd say a bit more about how, as a regular process, the influence of voices from the public actually does play a role in terms of monetary policy decisions and thinking, because that's a topic I think is not at all well understood by the public.
Well, we have through the Reserve Bank system, we have a unique really presence in communities around the United States, and we're present in not just in the business community but in educational, medical. Through our community affairs groups, we're present in neighborhoods, and we harvest that information, and it goes into a lot of what FOMC participants say. It goes into the research that we do, it goes into the data that we collect. We collect a lot of unique data on diverse outcomes among different groups and that kind of thing. And all of that goes into our FOMC deliberations. In particular, it informs our understanding of what maximum employment really means. So we focus on, at every FOMC meeting, in every briefing, in pretty much all of my public remarks and my colleagues' public remarks in the monetary policy report, we will call out different, for example, unemployment rates and labor force results for different racial groups. Not just because it's the right thing to do, it really does inform our thinking about maximum employment. And so this is something that we're very focused on. These disparities are a longstanding feature of the American economy, and they really do hold us back. As Raphael Bostic so pointed out so well recently, they weigh on the whole economy, and so all of that goes into our thinking, not in a mechanical way, but in our understanding of what maximum employment is. And that's why you saw during 2019, when the unemployment rate fell to 3.5%, well below most estimates of the sustainable rate, the natural rate of unemployment. You didn't see us raising rates or expressing concern. You heard us celebrating that, and you actually saw us cutting rates during 2019. Not because of that, but nonetheless, we weren't hesitant to cut rates because of the very low level of unemployment.
So just to follow up on that a bit, you have made some very strong and very clear statements about racial justice and the challenges of economic disparities, particularly related to racial inequalities. And of course, we know that many of those disparities are in such clear relief in the current context. And so I'd like to ask you to say a bit more, having explained to us that the employment mandate will be interpreted in a broader and more inclusive way. What else can the Fed do to address some of those really important disparities?
So I would say, as I mentioned, these are long-running features of our economy, which figure into our understanding of the economy and into our decisions. And I would say also that while they're long-standing, the pandemic has really shown that the effects of the pandemic have fallen to a large extent, not exclusively, but to a large extent, on people working in the service economy, in public-facing jobs, and these relatively low-wage workers, and that's been heavily skewed toward minorities, women, low and moderate income community. So, what can the Fed do? So as I mentioned, we do already. If you look at the record, we're doing lots of research around these issues. We're talking about it publicly, and we are talking about these issues publicly, and we're incorporating into our thinking. I think the key thing, though, is that the single most important thing we can do here is to support a strong labor market. And as I mentioned earlier, that is something that we can do, but that is more of an all-government, all-society project that we need to take on forcefully. it can't just be the way the Fed manages interest rates through the business cycle. Although, in other words, it's not to wait until the eighth and ninth year of the cycle to get those kinds of results. Is we can do better than that, but with other policies. I think so. I think we're doing those things that we can do. I think a lot of them we're doing, and we'll keep looking for new ways. It is important to point out, though, our interest rate policies and our other policies affect all Americans and are for the benefit of all Americans. They're just, in that sense, blunt tools, and there are better tools for dealing directly with distributional issues, and those are the tools that are held in our system of government by elected officials and the people who are appointed in the executive branch who work for an elected official. So it is, as I said, it needs to be an all of government, all of society kind of thing. We'll keep doing what we can do, but I wouldn't. We really need it to be broader than just the Fed, and I think we're sort of doing the things that we think we can do now, and we'll keep doing them.
So it certainly does it have to be a broader effort. In that context, I wanted to just ask you a bit about some of the special programs, the facilities to try to get funds out into the community, in particular in places and for groups that are really struggling. As you know, the Fed has come under some criticism that some of those facilities are not reaching some of the groups that are the hardest hit. For example, minority businesses are often described. And I wonder if you'd say a bit more about whether there are additional things that the Fed could be doing, perhaps in partnership with others in that context.
So we did a lot of, on the Main Street facility, we did a great deal of outreach to community development financial institutions and minority depository institutions and other organizations that represent those constituencies. And so we're doing everything we can to reach those constituencies. Remember, this is a very broad program designed to make loans. So these are loans that we can make. We can't make grants the way effectively the PPP program does. That's really fiscal policy. What we're doing is we're making loans, and the law requires us to have a reasonable expectation that the loans will be repaid. A bank has to keep a 5% piece of that loan. So we are working to reach smaller and medium-sized businesses through that. But I do think this is a unique exercise for us. We've never done anything like that, lending to businesses. I would say we've never done it, but we've never tried to reach out broadly like this, particularly to smaller institutions. We're really not the ideal, and we're doing it. We've put more effort and work into the Main Street facility than everything else we've done. It's a very, very challenging exercise. We're making progress there. I think we're getting more and more banks signed up, more and more loans getting made. CDFIs and smaller community banks are in fact active. But it's going to take more than that. It's going to take, more direct aid, I think, to smaller businesses. And I think that's an area where fiscal policy can really do things that it's very hard for us to do. And in fact, the P program has been doing. So I would look to policy for help there.
Yeah, and so clearly it has to be a partnership to have the kind of broad impact that we would hope to see. I do want to talk a bit about the current crisis compared to other crises that the Fed has grappled with, and in particular, one of the questions that I get asked is, to what extent, from the perspective of monetary policy, is grappling with a major recession that's caused by a pandemic any different from grappling with one that is caused by a financial crisis, as we saw back in 2008, 2009. Be very interested in your thoughts about that difference.
Yeah, so it's a very, very different situation. The two episodes, and I think so far the two beginnings of recovery and that recovery are quite different. This crisis did not originate in the financial system or from an asset bubble or from an imbalance or anything like that. And all of those were features of the housing bubble, housing crisis, and and the financial crisis. That was the heart of the global financial crisis, and it was global in that sense. This really was a natural disaster that hit an economy that was doing well, with a banking system that was well capitalized and highly liquid and understood its risks pretty well, and has actually been a source of strength. So that's very different. Although we have seen lines emerge in the broader financial system, in the capital markets, for example, under great stress. We've seen something, and no doubt we'll come back and look at those when it's time to do that. I mean, what happened here was essentially people around the world, sometimes required by their government, sometimes on their own, withdrew from certain kinds of economic activity to protect themselves from the pandemic all around the world. There's no precedent for that. There's no playbook for that. So our response was actually quite different from what it was in the financial crisis. So we immediately cut rates to zero. We raised our asset purchases essentially without limit to support market function. We weren't trying to stimulate the economy in the sense that the economy was partially shut down. The idea was not to stimulate people to go out to spend. It was to provide a little bit of comfort, to assure that credit was flowing to households and businesses, and then when the expansion came, to support that recovery and expansion with monetary policy. So very, very different. Also, this business of lending to non-financial corporates and also to state and local governments, unique. And that was because the intermediation process simply stopped. The financial system, there was such a flight to safety when the pandemic really hit that credit intermediation between savers and borrowers just essentially stopped. And we had to step in as a backstop for the municipal market, for the corporate markets, and have been doing so for smaller businesses. And we did so around the world for dollar funding markets. Now that was similar to during the financial crisis. So it's very different. But I would say this though, so we had the deepest quarter loss in GDP that we've ever had. But remember, the economy was strong back in February. So there's a lot of strength in the economy. The recovery in May and June came sooner and was stronger than expected. So there's still a healthy economy under here, except for this area that's been directly affected by COVID. So if we can keep the disease under control, the rest of the economy can recover fairly quickly. The problem this time is that there's a particular part of the economy which involves getting people together and feeding them, flying them around the country, having them sleep in hotels, entertaining them. That part of the economy will find it very difficult to recover. That's a lot of workers. That's millions of people whose jobs they're really going to struggle to find work. And we need to stay with those people. We need to support them and help them get back into their working lives, stay in their homes. Congress has done a lot on that. We've done a lot, and we'll keep doing what we can. But I do think it's that's going to be the issue. I think we will get through this period, maybe with some starts and stops, with reasonable growth. But ultimately, we're looking at a long tail of probably a couple of years at least of people of relatively high employment, as people who worked in those industries will struggle to find work. And again, we need to support them.
Yeah, so kind of very different trajectory as you've described.
Right.
So in that context, do you see any role for the Fed in terms of those financial institutions that really do community development?
We're very highly engaged with the CDFIs, the community development financial institutions, and those of them that are banks, are taking part in our programs now. They took part in the PPP liquidity facility, so we strongly support them, engage with them, and the same is true of MDIs. I think that isn't where the liquidity shortage is. That isn't where the big problems in the economy are really in the service sector and the manufacturing sector. It's in the real economy this time. The last crisis was really around the financial system and big credit losses. Here we've got highly capitalized institutions, and we have credit problems in the real economy, and we have we have a different situation this time.
Thank you. So we are almost out of time, unfortunately, and I thought what I would do for just our last minute or two was to cycle back to the review, this very public review of the monetary policy framework, and ask if you had any kind of additional thoughts or perhaps the next steps that you expect the Fed to take in terms of moving forward with the changes that you've described for us.
Well, first of all, I'm very pleased with how this worked out. Again, I think it's productive both from the standpoint of just public engagement, and that's always a good thing for an institution like the Fed, particularly the Fed, which has this precious degree of independence, and I think that puts a burden on us to seek accountability, not just go through the motions, but really actively engage and explain ourselves as clearly as possible to the public and the public's elected representatives. So I think the review has helped on that. I think in that sense, it's been a success. I think really the changes to our framework, time is going to tell. And what we do going forward is really going to decide the effectiveness of the changes we've made. I think it's a very promising set of changes to deal with what is a reality of a quite difficult macroeconomic context of low interest rates, low inflation, relatively low productivity, slow growth, and those kinds of things, and a flat Phillips curve. You have to put all that together and see that we've really got to work to find every scrap of leverage in helping stabilize the economy, which is our role. So time will tell, and our actions ultimately tell. But I'm very pleased with you and so grateful to be part of such a great organization where we've really used every part of the organization to advance this project, and I'm really proud to be part of this.
Thank you very much, Chair Powell. It was really a pleasure both to speak with you this morning here, but also I'd like to congratulate you and the Federal Reserve team, a thoughtful and publicly engaged review of the monetary policy strategy. So thank you very much.
Thank you very much, Susan. Good to see you.
Good to see you as well. And now we'll shift to the second session in today's agenda, which will focus on the trend decline in growth. And the paper for this session will be presented by the author, Ufik Akajit, from the University of Chicago.
So thank you very much for this kind introduction. Today, I'll be talking about the productivity slowdown and the declining business dynamism in the US and around the world. And this is joint work with Sinatesh from Federal Reserve Board. As all participants are familiar with, there has been a productivity slowdown in the US over the past several decades, and it is important to understand the underlying mechanism in order to come up with the right policy recommendations. So what we try to do in this background paper, is to put together several other trends at the micro level that can shed light on the macro productivity